Good afternoon, everyone. Welcome to the Pitcher Partners presentation on the JobMaker hiring credit. My name is Alexis Kokinos and I am a partner in our national tax group at Pitcher Partners. I've been heavily involved in the consultation on all of the stimulus measures, including the cash flow boost, the JobKeeper regime, and the capital allowance provisions. And I'm recently been working with the ATO and the Treasury on a confidential consultation dealing with these JobMaker provisions. Today I am joined by Peter Gillies, who's a director in our national tax team, and Leo Guzenfeider, who is a senior manager in our national tax team. Both Peter and Leo have also been heavily involved in the consultation on these measures. Just a bit of housekeeping before we commence this webinar. This is the last webinar for the year. In regards to just questions during the session, the Q&A function for this webinar is for technical issues only, so you won't be able to ask questions during the webinar itself on any of the matters that I'll be discussing. However, if you do have any questions arising out of the presentation, please feel free to contact either your regular Pitcher Partners contact or one of the tax experts listed at the end of the presentation. If you've missed any of our previous webinars, including our JobKeeper or any of our other sessions that we've run previously, you can view them on our YouTube channel and on our website. There's additional material covering a number of issues available on our website as well. Just a reminder as well, we are recording this webinar and the recording of slides will be distributed to all attendees within the next 48 hours. So getting to the presentation, just as some background, the government stimulus measures have to date been well targeted to the phase of COVID. The government commenced with broadly a job seeker regime to support unemployment and quickly moved to a JobKeeper regime to keep people in employment in their jobs, even though a lot of businesses had shut down. Now, the JobKeeper regime continues to be applied until the end of March 2021. For eligible employers who still qualify for that regime, but there has been statistics released during the week that there's been less of a take-up of the extended period for JobKeeper. Now, as we all know, the JobKeeper regime was a very generous regime that helped support businesses and employment during a very rough period through the COVID closures. Now, moving out of the JobKeeper regime, the government has their third regime, which is this JobMaker regime, where they'll be providing a credit for hiring eligible employees under this new JobKeeper regime. This regime commenced on the 6th of October 2020, and while we don't have official rules, it is actually currently applying. Now, while not as generous as the JobKeeper regime, the regime has been budgeted to cost the government around $4 billion over a 2-year period. The credit provided is to act as an incentive to hire additional employees aged between 16 and 35 years old, and the government believes that this will support around 450,000 new positions for young Australians. Now, in my opinion, the JobKeeper regime has been very costly, but has been very successful, I think, in achieving its purpose. However, when we go through the JobMaker regime, I have a fear that this regime, the JobMaker regime, won't be as successful in encouraging 450,000 new jobs. And while at the heart of the regime, there's a simple idea, i.e. you get a credit for each employee that is hired when they're an eligible employee. The system, as you'll find out today, is very complex and requires a substantial amount of STP data in order to calculate the credit. And the perceived complexity and potential compliance costs associated with the regime may result in, I believe, a lot of employers not seeking to take advantage of the regime. We have put these comments through to the ATO and Treasury during the consultation periods, and only time will tell if our views that we've expressed will be correct in terms of take-up. Accordingly, the purpose of today's session is to outline how the regime will work, but also demonstrate when the regime may provide you with a benefit in order to assist your own review of whether it's worth your time investing in the regime, depending on your expectation of receiving credits. We'll also try to outline what the compliance requirements will be, and therefore outline what you will need to think about when going into the regime. Now, what I'm going to do is ask Peter if you can jump back one slide just to go through the outline for today. So what we're going to cover today on the job maker regime, we're going to provide a bit of an overview, just the basics of the regime, and then we're going to cover who an eligible employer is, so who can qualify for the regime. We're going to talk about which employees will be eligible in order for the employer to receive a credit in respect of hiring that employee and for how long. We'll talk about the integrity provisions, and we'll actually go through a calculation of the entitlement. So that will be what we cover today. So if I move to the next slide, I'm going to cover the overview before passing on to Peter. So the JobMaker regime is intended to support employers looking to hire employees that have been receiving either JobKeeper, youth allowance or parenting payments. So essentially the aim of this regime is to replace one government supplement that those persons may otherwise be receiving with another, being the JobMaker supplement that they pay to employers. There's probably very little difference between the amount that those regimes would cost the government in terms of if they were paying, for example, JobSeeker or if they're going to pay JobMaker. So obviously there's an incentive for the government to try and push people into the JobMaker regime so that they can encourage employment during this period. As outlined on the slide, the JobMaker regime can provide a subsidy or a credit to an employer of between about $100 and $200 per week for each employee, depending on what age the employee otherwise is. It equates to roughly about $5,200 for what we'd say is the lower rate employee and about $10,400 for the higher rate employee over around a 12-month period. Now, this can be quite a substantial subsidy if you are looking to hire a number of employees, and it can work out to be quite a generous regime. Now, obviously, the amount of that approximate subsidy can vary. As you'll see through the calculations, it is calculated on a day's basis, not really a week's basis, and people can straddle more than 12 months under the regime. So you may get something a little bit different to those figures that I just mentioned. Now, while this regime should be fairly i.e. you just pay an amount per week per employee that you hire that are otherwise eligible, unfortunately, this is perhaps one of the most complex COVID regimes introduced by the government. The calculations are based on STP information and generally speaking are almost impossible to calculate unless you do use a sophisticated calculation model. The complexity, as Peter and Leo will outline, is driven a lot by inbuilt integrity into the calculations. So in most of the other COVID measures, what they did was they put in general integrity provisions, which the ATO had to review later on to determine whether you would qualify or not. Now, this regime is a little bit different. What they've done is put a lot of those integrity rules into the calculation so that it's automatically tested by virtue of what you submit as your information. And just by a very basic example, if you hired 4 eligible employees during a period, yet you had reduced your staff by 5 members, unfortunately your numbers have gone down, so your employment numbers have gone down, so your calculation methodology will determine that you're not eligible for the credit. So that is built into the calculation, as you'll see a bit later on. So we will go through the complexity of the calculations during the session. It is worth noting that we have built a basic model that's still in draft at the moment that we're hoping to finalise once the rules are final. We've also assisted in reviewing an ATO draft model, which we've done in the last couple of days, which we understand they're going to also make public. And so hopefully there'll be a number of these tools that will become available to assist in your calculation and a determination of the credits that you otherwise may be able to get. We've also seen how all this data integrates through STP into the portal, the ATO's portal. And it will all be automatic. Once you submit your STP reports, you'll go into your portal and you'll be able to see how the calculations are done, and it will calculate the credit automatically for you without you having to do much. So there's not much in terms of having to do things in order to calculate them yourselves, but if you want to check the dollar figures that you get, obviously the numbers won't be intuitive and you'd have to redo a calculation yourself, which can be quite complex. Lastly, just for this slide, I'd just like to mention that while today's session is very detailed, it's based on a set of draft rules which could change once the final rules are released, which could be any time today or next week. there are a number of issues we've submitted on those rules through the consultation process and a number of unresolved questions. For example, if you have a consolidated group, it's still unclear how it will apply to a tax consolidated group. We don't expect the draft rules are going to change materially because they have built a lot of processes in the background, so I don't think they can change the draft rules materially. However, they could change slightly, so please bear this in mind during this presentation, as that commentary may be subject to potentially change. Essentially, under this regime, employers need to be aware that there is quite a bit of reporting under JobMaker and a number of elections and notifications that need to be made. Probably the most important is the registration system, which we believe is to open next week. This is outlined in a Treasury fact sheet where they expect that to start from the 7th of December. Under the draft rules, you have to participate. You have to make a notification or elect to participate before the end of a period. Which, for the first period, which started on the 6th of October this year, so it's already these rules are applying. The period ends on January the 6th, so it doesn't leave employers a lot of time to register for this regime for the first quarter. Now, we're hopeful the ATO will come out and say they'll extend the registration date. However, at this stage, we haven't had any information on this. So given the drop dead date, once registration's open, even if employers aren't looking to use the regime, we are recommending you at least go through the process of registering for JobMaker. At least if you register during the period, you'll be eligible in that first quarter, and then you'll have a lot more time to work out whether you have a claim or not a claim for the quarter one. It is quite important, I believe, to try and look at registration for this very first quarter over the next couple of weeks, even though it will probably be an incredibly busy time for most people. The second item is just employee notices. So an employee needs to provide the employer with a notice confirming they're otherwise eligible to participate in this regime. This will include confirming their age and pre-commencement requirements, i.e. that they potentially were on JobSeeker for a requisite period. While this sounds cumbersome, this is not like the employee notice for JobKeeper regime. Under JobKeeper, you need to get a notice from everyone. Under JobMaker, you might only have 5 employees that are eligible, so you may only need to have a notice for a small number of people in terms of receiving the credits. The last item on this slide is just the end of period reporting. Employers do need to submit data to the ATO through their STP, which will include employee details, qualifications of the regime, payroll details, etc. As there's a limited number of exceptions to STP, it's going to be important to ensure that your payroll software is compatible with JobMaker reporting. I don't believe a lot of software companies have come out saying that they will be compatible. So you do need to check if you are going to be in JobMaker that you can actually submit those STP reports through your payroll software. Because there'll only be a limited amount, or maybe only be a limited number of employees that are otherwise eligible, reviewing the STP information may not be overly burdensome, but unfortunately the only way of really submitting the data will be through STP. Okay, that brings me to an end of the notifications. I'm going to now pass on to Peter, who's going to talk about the eligibility for employers.
Thanks, Alexis. So as an overview, in order to be entitled to participate in the program, the employer needs to satisfy a number of obligations or requirements. So obviously the first thing is we need to be within the JobMaker scheme periods. And as Alexis has mentioned a couple of times, we are within the first JobMaker period and rapidly heading towards the end of it. The second is that the employer must satisfy a number of what I might call entity-related requirements in order to qualify for the JobMaker credit. And then, as Alexis has said, at the heart of the scheme is some requirements in relation to increasing the employer's headcount, as the term is used in these draft rules, so increasing the number of employees, and in particular focusing on the number of additional eligible employees, because there are requirements around which employees you hire that would entitle the employer to a hiring credit. In addition to the headcount increase, there has to also be an increase in the total payroll. So that's part of the integrity rules. Importantly, an employer cannot participate in JobMaker if they're also participating in JobKeeper, with one exception, and that is the JobKeeper fortnight that overlaps with the period of participation in the JobMaker scheme is okay. It's just that the employer can't receive JobKeeper in respect of an employee for a JobKeeper period, a JobKeeper fortnight that starts within the JobMaker period, and also receive JobMaker credits for the same individual. But importantly, that's can't have any employee on JobKeeper during starting in the JobMaker period. Not that it's JobKeeper for that particular employee. And then, as Alexis has already mentioned, there's certain requirements that the employer needs to satisfy in terms of providing information to the Commissioner. Obviously, the first is the election to participate, and then on a periodic basis throughout the scheme, reporting on an end of quarter or end of 3-month period basis. So just to detail what we mean when we refer to a JobKeeper period, there's 8 periods of 3 months. You might refer to them as quarters, but they're not quarters as one would typically understand them. As Alexis has mentioned a couple of times, the first one's already started on the 7th of October, due to finish on the 6th of January, and the whole scheme runs through to the 6th of October 2022. Now, the first 4 of those JobKeeper periods are particularly important, as I'll come in to talk about, but an employer can receive hiring credits under this scheme during the entirety of that period. Looking then at the, as I referred to them before, entity-related requirements for an employer to be eligible. And for those of you that have had any involvement in JobKeeper, you might see similarities between the detail on these slides and what was required for JobKeeper. And indeed, there's some overlap with the original cash flow boost scheme as well. So at the entity level, the employer needs to have an ABN, needs to be registered for PAYG withholding, needs to carry on business in Australia. They're not for profit, pursuing charitable objectives, principally in Australia, or be one of a specified number of international aid organisations. So those requirements need to be satisfied from the date of enrolment for as long as the employer participates, and then again throughout the period of enrolment, but assessed at the time of making each JobMaker claim. The entity must be up to date with their income tax and GST lodgement requirements for the 2 years ending at the claim time. Now, the claim time is, broadly speaking, the date at which the calculation of the entitlement for the relevant JobMaker period is submitted to the tax office, or if you like, the end of each JobMaker period. So certain entities are specifically excluded. This list is consistent with the exclusions from JobKeeper, and there's nothing particularly difficult about that. Ones that we would particularly focus on in our practice area would be the last 2, whether or not an entity has had a liquidator or provisional liquidator appointed, or in the case of a sole trader, a trustee in bankruptcy appointed. So if either of those apply, the entity is excluded from participation in JobMaker, as they would have been excluded from participation in JobKeeper. Focusing then on the requirements in respect of an individual, so which individuals would qualify the employer to receive the JobMaker hiring credit. And just at that point, let me say that unlike the JobKeeper program, where broadly speaking, the idea was that the subsidy received by the employer was passed on to the employee, JobMaker doesn't work that way. So you would employ the employee on their normal salary. If they qualify, and you qualify, then you would get the subsidy that Alexis has already referred to, the 200 or 100, depending on the age of the employee. So in that sense, it's different to JobKeeper, but some of these requirements are consistent with what was required for the JobKeeper program. So obviously, to be a qualifying employee, the employee needs to be employed, or the individual needs to be employed. Further, they need to have commenced employment on or after the 7th of October 2020 and before the 6th of October 2021. So for those of you that remember the JobKeeper periods, that's the period covered by those first 4 JobMaker periods. And essentially the idea is that employers can receive the hiring credit for up to 12 months or so for each eligible employee. And the reason for the subsequent, or the 5th to the 8th JobMaker periods, is that if you're employed in October 2021, then obviously the employer has an ability to be entitled to 12 months worth of JobMaker credits, which runs out to the end of the 8th JobMaker period. But individuals who would otherwise satisfy the requirements that are on this slide, employed after 6th of October 2021, wouldn't qualify the employer to receive a hiring credit. So then looking at the individual, at the date of commencement of employment, they need to have been at least 16 but less than 36. They need to have been in receipt of job seeker, youth allowance other than as a full-time student or new apprentice, or parenting payments for a specified period of time, which is 28 days in a certain period leading up to the commencement of employment. So there is that pre-commencement obligation that needs to be satisfied. Then throughout the period of employment, in order for the employer to be entitled to a credit, the individual needs to have worked at least 20 hours on average over each 7-day period. Then the requirement for notice for the individual is that they, in the approved form, advise the employer that they satisfy the age requirement and the pre-commencement requirement, so that they were in receipt of job seeker, youth allowance or parenting payment, and that they haven't got a operative arrangement in relation to another employer in respect of JobMaker credits. Now, there are certain individuals that are excluded from qualifying as eligible additional employees, and broadly speaking, the exclusion is for a relative of the business owner or controller, which covers off on the sole trader company and partnership arrangements, or more broadly in the context of a trust, is a relative of the trustee or a beneficiary of the trustee, a relative of the beneficiary, or where the trustee is a corporate would be a relative of a director or shareholder of the corporate trustee. More generally, there is a requirement that an individual who worked or provided services to the employer as a contractor at any time in the 6 months leading up to the 6th of October 2020, the commencement of the JobMaker periods, who is subsequently engaged as an employee to perform substantially the same functions or duties and with the same powers as they had as a contractor, then that contractor come employee would be an excluded employee, one for whom the employer could not claim JobMaker credits. Turning then to look at the integrity measures, and again, these are generally ones that also apply in relation to cash flow boost and JobKeeper entitlements. Just noting the material ones, all of those schemes provide for a joint and several liability where a claimant has been overpaid their proper entitlement, and the joint and several applies to the claimant as well as anybody who assisted in the application that resulted in the overpayment. Perhaps of more significance is the contrived schemes integrity measure, and in relation to the contrived schemes, integrity measure. The explanatory statement that accompanied these draft rules provides, and hopefully you can read that, that the sorts of arrangements that would be caught within the contrived scheme provision would include those where an employer has artificially inflated their headcount or their payroll amount, for example, by bringing on an eligible new employee but reducing the hours of an existing worker who's over 35 years of age, so 36 or older, in order to give the appearance that they satisfy all the rules, when in substance there hasn't really been an increase as required under the schemes. So a contrived schemes integrity provision. Then the explanatory statement goes on to warn that there are other legislations that, or other legislative schemes, perhaps more properly said, that employers need to be worried about if they're seeking to fiddle the system. So those include the Age Discrimination Act and the Fair Work Act. So some things then to be concerned about if you are not genuine in your application and claims. Also, there's the normal, normal taxation offence provisions, making false or misleading statements, and obtaining financial advantage by deception in the worst type cases. So none of that's specific to the JobMaker scheme. So now it's my great pleasure to hand over to Leo to lead us through some calculations.
Thanks, Peter. So as Peter mentioned, for the remaining part of today's session, we just want to work through some of the mechanics of these rules because they do get fairly complex and they introduce a lot of new concepts. So I was trying to make people familiar with them as best we can and outline how much an employee could possibly receive under the JobMaker scheme as a result of hiring people as pursuant to the incentive offered. So as Peter mentioned, there's these broad integrity rules, such as entering into a contrived schemes or discriminating against employees, but also that the way the entitlement is calculated attempts to build in or hardwire certain integrity measures into the calculations themselves. And so here, just a refresh of what the scheme is advertised as. For what's known as eligible additional employees, an employer can get $200 per week or $100 per week for a year, depending on the age, with those aged 16 to 29 considered high-rate employees. Key thing to note is that the status of being a higher or lower-rate employee is determined on the day they commence employment, and it doesn't change throughout the JobMaker schemes. For example, if they turn 30 in the first year of employment, they won't switch from being a higher rate to a lower rate, or if they turn 36, they don't stop being eligible by dropping out of the lower rate category. So it's just tested once, date of employment or commencement of employment. And so this headline amount of $200 a week or $100 per week, it's reduced if the employer's headcount or its total payroll is not maintained from certain baseline amounts, with those baseline amounts being determined just before the date of the announcement of October budget. And Alexis alluded to this earlier, meaning that it won't necessarily work out to be the full, let's say, $10,400 a year for a high rate employee or $5,200 a year for a lower rate employee, because there are these kind of reductions that occur if you don't maintain these payroll and headcount amounts. So the calculation of the entitlement gets fairly complex fairly quickly to take these reductions into account, and we'll go through these in a case study and explain them as best as possible.
So just outlining some of the new concepts that are introduced in the JobMaker regime. First is the headcount increase. Now, basically, this is just the increase in staff employed by comparing those employed on the last date of the JobMaker period, such as the 6th of January 2021 to the 30th of September 2020, which is kind of our baseline date. And this is all staff that are employed, not just those that are eligible for JobMaker. So the idea being that an employee is required to maintain staffing levels overall to maximize their credits, not just to hire certain eligible JobMaker staff, while others sort of get a reduced pay or lose their job. So the baseline is adjusted for the second year of the JobMaker scheme, which is one of the more confusing or complicating parts of the calculation. And that adjustment takes into account any new hires under JobMaker in the preceding year, so that once an employer's entitlement in respect of those employees runs out after 12 months, you can't just let them go either if you want to maximize credits for some eligible employees that were hired later on. Now, the payroll increase. Now that's a difference between the total payroll in the JobMaker period compared to a baseline payroll amount, which is tested just prior to the 6th of October 2020, the day of the budget. Now, the way this is determined is to compare the gross salary and wages in the JobMaker period to the gross salary and wages in that period prior to the 6th of October, like using the same amount of days. So we'll compare the amounts paid in the, let's say, the last 92 days or 90 days prior to the 6th of October, depending on whether we have 90, 91 or 92 days in our JobMaker period. And those are the three possible amount of calendar days in our JobMaker periods. So the key is that you count amounts paid in the period rather than for the period. So for example, if a payday occurs on the 7th of January 2021, but that's for work done all, ending in the period before the 6th of January, even if that work all occurred in that first JobMaker period, the pay doesn't count towards the payroll amount in that first JobMaker period because it was paid on the 7th, which is the start of the second JobMaker period. This measure is, again, simply to prevent an entity hiring more staff but paying staff less overall by paying the new eligible staff wages at the expense of older staff by taking away some of their work. Now, it's interesting, the draft rules made you compare the exact same number of pay cycles. Like they had a rule to make sure you're comparing apples and apples, but the final rules don't do this necessarily. So you might get an issue where you could have, let's say, 7 fortnightly pay cycles or pay days that occur in your baseline calculation, let's say the last 90 or 92 days before the 6th of October. But in your JobMaker period, you might only have 6 pay dates, depending on just the way they fall based on the calendar in that 3-month block, which could be unfavorable, or it could work the other way. You might have 6 pay dates in your baseline and 7 fortnightly pay dates in your JobMaker period. So it could work for you. Now, I guess we await ATO guidance on this issue, as there might be some strange outcomes or unintended outcomes by this rule being removed to ensure you compare the same amount of pay cycles, which isn't in the rules anymore. Now, the concept of higher and lower rate days. These are the days that eligible employees are employed in the period, not days worked, so just days that are employed in the JobMaker period. The key, again, to be eligible is that you still need to pass this 20-hour-a-week work test. But, that could possibly be met by, for example, a staff member working 7, 8-hour days for about 40 days in the 90-day JobMaker period and not even working on any of the other 50 days. They could still be eligible, and their higher or lower rate days can still be the full, let's say 90 days, even though they might have been off for a month, for example. And one thing to note about this, that a rule was added in the final set of rules to cap the number of higher or lower rate days that count to 365 for an employee. So, for example, an employee who joins partway through the first JobMaker period that could remain eligible in the 2nd, 3rd, 4th, and 5th JobMaker periods, but sometime in the 5th JobMaker period, which is a year ahead, you're going to stop counting their days. So, for example, someone hired on the basic case the 1st of January 2021, that's right towards the end of the first JobMaker period. You'll stop counting their days on the 31st of December 2021, which is in the 5th JobMaker period. So you won't count those days after the 31st of December 2021 being the start of January 2022. 2. Now, the maximum payable days is where the scale back kicks in that we've mentioned. So an employer can only be paid for a number of days based on their net headcount increase, even if their eligible JobMaker employees have increased by more than that. As a basic illustration, and Alexis alluded to this earlier, if an employer hires 2 25-year-olds in November, let's say 2020, they were previously on JobSeeker and eligible employees, but one older employee resigns, their last day could be on the 6th of January, the last day of the first JobMaker period. That employer will only get JobMaker for effectively one additional employee, as the maximum payable days will be based on only this net headcount increase of 1, 2 new staff hired and 1 left. So that's sort of where the scale back applies. So what is the amount of the JobMaker hiring credit that an employer gets? The first thing to note about this is that it's determined on a global basis per entity, which is in contrast to JobKeeper, which was a per employee amount, for example. It was much simpler. We had $1,500 per employee per fortnight, or reduced amounts as we went through the JobKeeper extension. But in the JobMaker, we don't have an amount per employee. We just have one amount for the employer for each of the 8 JobMaker periods potentially. And also, unlike JobKeeper, it's probably really difficult to forecast. With JobKeeper, you really just have this one contingency that, as long as a staff member remained employed throughout each fortnight and you pay them the amount as per the wage condition, you could easily sort of anticipate you'd get the full JobKeeper payment, and you could sort of forecast what that would be fairly comfortably. But with JobMaker, you've got more contingencies, which, the added contingencies are maintaining the overall headcount or overall staffing levels at the end of each JobMaker period, and also maintaining the overall payroll, so making sure the total amount paid stays above the baseline amount. And some of those things might be out of your control because some staff could just leave unexpectedly towards an end of a JobMaker period, and that means you might lose some or even all of your entitlement for those eligible staff that an employer did hire, as a response to the JobMaker incentive. So the calculation, it's the lesser of 2 amounts, and we alluded to these 2 concepts here. We're looking at payroll and headcount amounts. So firstly, we'll talk about the headcount amount. So what is this? It's basically the concept, you can sort of see it looks like the amount of that $200 or $100 credit, depending on what kind of employee you are, higher or lower rate, but it's just modified to take into account employees who get hired part way through a period, which is why it's asking you to multiply the number of days and divide by 7. So look, despite it being advertised as a weekly rate, really it's a daily rate once you look at the detail. Effectively, it's $28.57 a day for a higher rate employee that's employed, and $14.29 for a lower rate employee per day employed that they're eligible. And again, we reiterate here this scale back, that it's based on this concept of maximum payable days. And the way the scale back works is where the total higher or lower rates days in a period, in a JobMaker period, exceeds the maximum payable days in the period. And if that's the case, you reduce the total number of lower rate days first until your total counter days, they call it, no longer exceed the maximum. So you lose the lower rate days first, which is, I guess, beneficial to employers. They lose the lower entitlement before they lose any days that count towards the higher entitlement. And look, if you lose all your lower rate days and your high rate days still exceed the maximum payable days, you've got to lose some of the high rate days to get that down to equal the total maximum payable days. And again, we'll go through this in a detailed work example shortly. Now, the payroll amounts on the right-hand side it isn't as complex, and hopefully should be easily determined based on payroll software. But just to reiterate the point that you might get some differing amount of pay days in your kind of job maker period as compared to the amount of pay days in your baseline period. Again, that's just a comparison between, how much did you pay in that job maker period versus how much did you pay in the equivalent amount of days ending on the 6th of October 2020 being the baseline.
And just on the next slide, just a quick summary of what counts towards payroll, and exactly the same as what counts towards the $1,500 job keeper test, effectively gross wages. So it includes amounts paid, amounts withheld from those wages, and any amount salary sacrificed into superannuation or any other form of salary packaging, maybe to a car, for example. So now we'll go through sort of a detailed case study, which has some very basic facts, but it does get pretty complex. We'll try to walk through it pretty slowly to try to tease out how this all works. So what we have here is BizCo. It's got 15 employees as at 30th of September 2020, just prior to the budget, and that will be the baseline headcount. So what BizCo does is, in response to JobMaker, well, it hires 10 of these additional eligible employees. 8 of them are between 16 and 29, they're higher rate, and 2 are between 30 and 35 on that 1st of December date. And they meet all the eligibility criteria and do the nominations. And obviously for simplicity, they all start on the same day. So what we have is, first we have a headcount increase of 10. At the 6th of January, which is the last day of the period, we've got 60 employees and we had a baseline headcount of 50. So that's our headcount increase. And the maximum payable days is simply that headcount increase of 10 by the number of calendar days in the period, which is 92. So we've got 920 of these maximum payable days. Now, how many actual higher and lower rate days do we have? Ends up being 370, which is effectively 10 lots of 37. So basically each employee was employed for 37 days, the whole month of December, and 6 days in January. So there's 8 higher, 2 on the lower rate, so we get 296 higher rate days and 74 lower rate days. So because of those total days of 370 do not exceed the maximum payable days, we don't need to do any kind of scale back, and we do this calculation. We multiply the high rate days by the $200 amounts, add the lower rate days by, multiply those by 100, and just divide by 7 to convert those into sort of daily amounts. And that would be the credit you would get for that period, $9,514.30. And so always, obviously, for each of these JobMaker periods, it's subject to the payroll having increased by at least $9,514 compared to the payroll just prior to 6th of October, the baseline payroll. So that's the first JobMaker period. Now we move along to the second JobMaker period, and we have one extra fact to keep things simple as possible. We have one employee who was an ineligible employee. They're not one of the 10 new JobMaker hires. They've been employed by BizCo, let's say for some years. So that employee resigns on the 1st of April, 2021. Now this second JobMaker period ends on the 6th of April, 2021. So that means we'll have 59 staff employed on the last day of that JobMaker period, meaning there's a headcount increase of 9 compared to 10 in the last period. So our maximum payable days are 810 in this period, 9, which is based on that headcount increase of 9 by 90 calendar days in that second JobMaker period. Now, because the eligible employees, all 10 of them worked, they were employed for the whole JobMaker period. There's 900 of these counter days, 720 high rate days and 180 low rate days. So again, based on 8 high and 2 low rate employees. So now we do have a scale back because our total counter days of 900 exceeds the maximum of 810. So we've got to scale it back by 90 to get, so we can only count, 810 of these days as per the maximum. The way you do that is you chip away at the lower rate days. So we reduce those first. So instead of 180 lower rate days, we have 90. And then we add those, we can still keep our 720 high rate days. So when you do the calculation, you're only counting still 810 days as per the maximum. And so you multiply 200 by those 720 high rate days and $100 by the 90 lower rate days as after the adjustments, and divide by 7, and you get, it's a bit more this period because they didn't come along partway through, like in December, they were there from day one on the 7th of April, on the 7th of January for the second JobMaker period. So that entitlement's a lot bigger, $21,857.15. We'll keep running through the periods. We've got 5 of them. We don't go through all 8, but again, we change one fact every time just to see how they all play out. So what happens in the third JobMaker period that's different? Out of 2 of our, call it eligible employees, these new hires back on the 1st of December, 2 of them just took May and June off on unpaid leave. So they're not actually considered eligible employees in this period because they don't meet that 20-hour a week on average work test. So they're just not going to be eligible additional employees, and the days that they were employed will not count as higher rate days or lower rate days in this period. So running through the calculation, we have headcount increase of 9. We've still got 59 employees compared to 50, but because these 2 employees kind of don't count as eligible, we don't count their days towards the higher rate and lower rate days. So effectively, we've got 8 employees counting towards these total counted days, 7 for the higher rate and 1 for the lower rate. So we get 728 total counted days. It's based on there being 91 days in the JobMaker period. And because that's below our maximum payable days, we don't have any scale back. So we just multiply 200 by those 637 higher rate days and add 100 times those 91 lower rate days. Divide by 7, we get $19,500. And we get this nice round number because 91 days divides perfectly by 7. It's exactly 13 weeks in that period from the 7th of April to the 6th of July. Now, for the 4th JobMaker period, from July to October 2021, the added fact here is that 2 extra employees resigned just before the end, before the 6th of October. They resigned on the 1st of October. So we've still got all those 10 new hires. They're still all there, but we've lost, since JobMaker started, now we've lost 3 other staff members. So we've only got 57 employees as at 6th of October 2021. So that means we've got a headcount increase of 7, meaning our maximum payable days are 644, being 7 lots of 92, the amount of calendar days. So because we have higher and lower rate days of total calendar days being 920, that far exceeds the maximum payable days, we've got to scale back. We've got an excess of 276 days. So first we reduce our low rate days, and we're only 184 of those, so we take those to nil. But then we've still got to reduce, those based on the maximum payable days, 92 further days. So we take those off the high rate days. So what we're left with is just 644 high rate days, which is the maximum payable days. Multiply that by 200, divide by 7, and that would be the headcount amount and the JobMaker credit in that period. Again, subject to the payroll increasing compared to the baseline by at least that 18,400 amount.
So now we'll move on to the 5th JobMaker period, and that's where the calculations start getting a bit more complex, because in the 5th to 8th JobMaker periods, which are in the 2nd year of the JobMaker scheme, there is these adjustments you have to make to your baseline headcount. It's no longer simply just the amount of employees as at the 30th of September 2020. So in this case, it no longer just stays at 50 for BizCo. We don't go through any further in this example. This is the last JobMaker period because BizCo won't have any JobMaker hiring credits in the 6th, 7th, or 8th JobMaker periods because all the eligible employees were hired in the first JobMaker periods, and they won't be eligible anymore in the 6th period because that's over a year after the end of the period in which they were hired. So look, if they did happen to employ some more eligible staff, let's say in October 2021, they could still be eligible for JobMaker hiring credits through to the 8th JobMaker period ending on the 6th of October 2022. But here we've just kept the example short for, I guess, a bit of simplicity. So in this example, again, our baseline turns out that it's increased by 4 using this sort of somewhat complex calculation. And it's the way you do that, it's the lesser of 10 being the headcount increase in the first JobMaker period 12 months ago. And the result of this formula here sort of rounded down, 370 divided by 92, which is effectively what was claimed in the first period, 370 counted days, or eligible higher and lower rate days in a 92-day period. So effectively, 10 eligible employees were employed for around 40% of that first JobMaker period, at 37 of 92 days. And using that calculation, like once you round it, you get a number of 4. So it's basically saying, well, because you got effectively 4 lots of JobMaker payments for those staff, we're going to bump up your baseline headcount by 4. So you've got to, hire staff on top of, the 10 eligible employees to get more of a, or maximize your credit. So working through that, we have this adjusted baseline of 54 rather than 50. And as it turns out, because we have 57 staff employed at the end of the period, which we still have 3 staff have left since the start of JobMaker, we only have a headcount increase of 3 once we do the adjustments. And with 92 days in the period, we have 276 maximum payable days. So it results in a very large scale back because we have 920 actual days. The 10 staff worked 92 days each. But what also happens is, because of this cap towards the higher or lower rate days, you stop counting those days once that employee hits 365 days. So here, as you see, we don't have the amounts of like 184 and 736 that we might have had, because the staff in this period only worked 55 days each until they hit their cap of 365 days of being an eligible member. So we basically only have 550 counted days, or 10 lots of 55. And if you add that to the 370 days in the first JobMaker period, that sort of broadly equates you to the full 920 days you'd get for a whole quarter. So it's sort of this proratering that's going on. So, okay, we work through that. We've got our maximum payable days of 276. We've got our total counted days of 550, which, because we stopped counting. Basically, we stopped counting on the 30th of November 2021, because once we hit 1st of December 2021, that's going over a year. Now, to scale back to 276, we've got to, first we lose all our lower rate days, because there's only 110 of those, and then we lose some more high rate days to get the 440 high rate days down to 276. And what is our headcount amount? It's just simply $200 multiplied by 276 of these higher rate days, and divide by 7. That gets us $7,855.72. So slightly lower than we've got the last few periods, but this is due to these capping rules, because this is kind of the 5th period for these staff members who you're not really supposed to get more than 4 periods. So you can get sort of 3 full periods and 2 sort of part periods that sort of add up to 1 whole period, so to get you about 4 total. So here we have a summary of the overall result for BISCO, and adding up all the amounts they're eligible for, it's worth a total of $77,157.17 under these facts, which, again, hiring 10 eligible staff on the 1st of December 2020. And again, stress that these amounts are subject to meeting the payroll increase requirements in each of the 5 relevant JobMaker period. So look, the amounts aren't immaterial, but clearly not as generous as JobKeeper payments would be. Getting $1,500 a fortnight per employee, and basically every employee, a lot more employees would be eligible for JobKeeper than JobMaker. Now, look, we've added this other column here to highlight, well, what could be considered a maximum or potential JobMaker hiring credit for hiring those eligible staff members on that date, 1st of December 2020. Like what could be done to maximize the credit, if we did that bit of hiring the eligible staff. Now, we'll go through these. In the first period, BISCO got the max. Everyone who was eligible worked their 20 hours a week and no staff left. So they get the full credit for that period that they could get. Now, in the second period, there were 90 lower rate days lost because one of the ineligible staff members resigned to reduce the headcount. So the headcount's only up by 9 rather than 10. Now, if they were to be replaced before the end of the period, so before the 6th of April 2021, they would get the headcount back up to 60, which would have resulted in that higher credit of just over 23,000 rather than just under 22,000. Now, in the third period, we had the 2 staff members who were otherwise eligible, but they were away on leave and they didn't quite meet that 20 hours a week average work test. So they were not considered eligible in that third period, and their days employed didn't count as higher rate or lower rate days. So if BISCO just ensures that all those eligible staff work enough hours in every JobMaker period, that maximizes the potential credit they could get. So the difference here, if those 2 staff did happen to just work enough hours in that period between April and July, could be $23,400 rather than $19,500. And the fourth period, sort of similar thing to the second period. 2 more staff resigned. So if they were replaced by the 6th of October 2021, to get the total headcount back up to 60, then you get the maximum potential credit. There'll be no scale back, as the maximum payable days would not exceed the higher and lower rate days. And the 5th period, you can see this larger difference between the actual and the maximum due to the adjustment to the baseline going up by 4. So again, if extra staff are employed to get the headcount up to 60 here, you get the full credit for those 10 eligible staff members for at least that part of that 5th period until they stop counting the days after they've worked their 365 days consecutively, been employed consecutively. And so that could be the difference between just under 8,000 to just over 14,000 in that 5th period. So if you did all that, you could effectively get 365 days worth of credits for those 10 eligible staff, or full calendar year. And that would equate to around just under $94,000 using that calculation. And just to note, look, if you add up the maximum potential credit in the 1st and 5th periods, $9,500 to $14,100, you'll get about this $23,650 odd amount, which is kind of like the one full period. So those are just 2 kind of part periods that straddle the bits in the middle. So it counts the period they were employed, and it doesn't count the period at the end once they've exceeded their 365 days employed. Again, this is all subject to meeting the baseline payroll in each period, because if payroll just goes down in one of those, the credit could be reduced to 0. So just a note on startup entities or newly established entities, because unlike JobKeeper, which had a fixed 1 March requirement for an entity to either carry on a business or carry on their charitable objects, and also had a fixed 12 March 2020 date for having an ABN, JobMaker just requires these businesses or charities to meet the that business or charity requirement and the registration requirement from the time of electing to participate in JobMaker throughout the rest of that JobMaker period that they wish to claim in. So that can be a later time. That can be effectively any time up until 6th of October 2021, a year into the scheme. So you can access it if you hire eligible employees as late as that. But just remember, you know, the employer needs to hire staff that were receiving job seeker or parenting or youth allowance payments just before commencement. So you can't just take employees from a related entity or even a business acquisition, as those staff will, you know, most likely not be eligible if they were, you know, working full-time or part-time previously. They most likely wouldn't be receiving one of those payments. So you can't just find staff from another entity because they wouldn't meet those social security requirements in most cases. And one thing that's actually kind of useful for startups is the baseline the baseline payroll and headcount amounts would most likely be nil. So they're going to be very easy to satisfy those requirements because they're still tested on these dates, either 30th of September for your headcount or the period up to 90 or so odd days up to 6th of October for your payroll. Now, if the entity didn't exist, at that time, then those amounts would essentially be nil. So it's, those are almost self-satisfying requirements. But obviously, to maximize the credits, you've got to make sure that you maintain your overall staff level. So you can't just hire some staff and if some leave, they could stop being eligible staff, obviously. But otherwise, new entities and startups aren't prohibited because there's no fixed date on which you need to satisfy those requirements, like there was for JobKeeper. So with that, I will hand back to Alexis, and he's going to summarize and conclude our presentation this afternoon.
Thanks very much, Leo. And just to reflect on the example that Leo went through and the complexity there, obviously, if knowing the calculations and the drivers of the calculations, that it can give opportunities to try to maximise the credits. And in that very last period in Leo's example, how he demonstrated that if the numbers went up by 5 and they didn't need to be eligible persons, if the numbers went up by 5, i.e. hired 5 casual staff members for 1 hour each during that period, you would get the maximum credit for that period. And this is where those understanding those calculations need to be very careful, because those are the types of arrangements that the HO could seek to apply the integrity provisions to as well. So there are a number of levers, number of drivers that you do need to be aware of as a part of this that can actually maximise the credit and give quite a substantial increase in the amount of the credit when those levers are pulled. But you also need to be careful if you're doing those for the purpose of trying to maximise your credit. Now, just as some key takeaways for today's session, I just want to remind everyone again that these are draft rules. And they are subject to some potential changes when they do get released, hopefully next week. We don't expect them to materially change, so hopefully what we've presented to you today will represent what will be the rules on the JobMaker. The key thing for everyone is, irrespective of whether you think you're going to use the regime or not, if you may be eligible to get into the regime, there's a limited period at the moment for registering to enrol for the first period. So we are recommending that employers, irrespective, should look to register. It is only completing the registration application form, which shouldn't be overly complex thing to do. So we are recommending that occurs irrespective of whether you're going to look to use the regime or not. Obviously, the regime is available to all employers, but will be limited to certain employees. So again, everyone should be considering this regime. As a part of it, you can see how complex this regime is. You can see who it otherwise applies to in terms of it's only going to apply to certain hires. And therefore, it is pretty important for employers to really have a look at whether this regime will be advantageous for them. And whether it's worth their while to go through the regime. For example, if you are only going to look at potentially hiring one person and you don't even know if they're on JobSeeker or not, and you may or may not have employees increasing during the overall period, you probably have no guarantee that you're going to get a credit when you do a calculation, and you may not receive it. Now, this could be compared to another employer, for example, who had to stand down a lot of staff during COVID-19, didn't get JobKeeper, but are looking to rehire now those staff members, and are looking to particularly go after people who are on JobSeeker. Now, Our understanding is that may not breach discrimination laws by advertising to go for certain people on Job Seeker. So you may try to hire those people specifically as a part of your rehire process. Now, if you had to hire 10, 20 staff to refill those positions, that could be a greater incentive for those employers in that type of situation. So it is pretty important to have a look at whether this could work for you, whether there would be advantages to you. You also need to make an assessment of the cost of complying with the regime. So what type of records you need to do. And this is going to include the STP reporting and what claim you may otherwise get. Now, although it will be through STP reporting, it does sound like it would be onerous. If you only have 5 or 10 employees, you might not have to submit a lot of data through STP. So it might not be overly complex to get that data together and submit that through the system. It's unlike JobKeeper, where you had to indicate all of the information for all of your employees. This may only be required for some of the employees that otherwise qualify for JobMaker. The calculations are very complex, but there will be models available that will assist you on estimating the amounts. And the STP reporting will link into the ATO portal and automate that. So although there is complexity there, that shouldn't drive you away from looking at the regime, because you should hopefully be able to calculate those using some sophisticated calculators. Finally, I think that one of the critical things is, because reports need to be lodged by STP, you should be talking to your software providers to understand whether they're going to be JobMaker compatible, as that's obviously going to be pretty important in order for you to access the regime. There's only very, very few exceptions to STP. So if you are looking at the JobMaker regime, it is very likely that you have to have your software compatible with this. So I'll just go on to the last slide. So that concludes our presentation on the JobMaker regime. As mentioned, it is a very complex regime. However, it can provide some substantial benefits depending on who you are. So hopefully we've been able to outline how the regime works and what it might otherwise mean for you. If you have any questions on the regime, please feel free to contact your Pitcher Partners advisor or send through your queries on the regime. We'll be happy to try to respond if that's possible. Again, thank you very much for attending our session on the JobMaker, and hope you have a great afternoon and a great weekend.